Hello, welcome everyone. Welcome to the manual accounting. Today we're going to use a book called Introduction to Manual Accounting, Chapter 8 for Master Budgeting. So this is book owned by McGraw-Hill with copyright 2022. Let's start one by one. We're going to have understand the learning objective on how, why organization, budget, and process they use in creating budget. The framework of budgeting is a detailed quantitative plan for acquiring and using financial and other resources for specific forthcoming time period. Okay, this is a very important part. I remember when I was doing an IPO project with Nomura Securities, there's about 5 years financial budget forecast that been given to me, and we have to analyze it. Same thing when I was with RSA. Royal Alliance, we do a lot of financial budgeting every year, and we submit it to the executive group. Number one, the company budget already covers a 1 year period corresponding to its fiscal year. The fiscal year in Canada and the US mostly from January to December. Some companies also use perpetual budget, which is about 12-month budget that continues to roll forward. This operating budget is per year basis. It is a mostly continuous 12-month budget and rolls over 1 month or a quarterly. So the analytical usually a comparison between quarter to quarter, but the operational budget only cover 1 year period corresponding to a company fiscal years. Okay, many companies divide their annual budget into 4 quarters. That is a standard practice here in North America, and a standard practice almost worldwide. Budget used two key purposes. The first one is doing planning, which involve defining the objective and preparing various budget and achieve those objectives. Second one is the control, which involves a step taken by management to increase the likelihood that the budget set down while planning are attained, that all parts of the organization working together towards a goal. To be effective, good budgeting system must provide both planning and control. So planning and control must be on hand in hand together to make it effective. Why do organizations create budget? From the planning perspective, there's quite a benefits here in terms of defined goals and objectives. There's benefits, and then you need to communicate the plans. You need to coordinate the activities. You have to uncover potential bottleneck. You also need to allocating resources, and you need to also think about the future plan. So the benefits is always there in terms of budgeting processes. Like look at this, from control standpoint of view, organization compare budget with the actual result. You need to want to improve your efficiency, effectiveness, and then you want to evaluate and reward employees. If the budget is achieved, then you're gonna reward employees through bonuses system. Yeah. And how go organization create budget? The first one, budget by relying upon combination of top-down budgeting and self-imposing budgeting. Self-imposing budgeting, a partial budget, is a budget that is prepared that full cooperation and participation of all managers at all levels. Okay, that's the key part. This is the self-imposed budget from top management all the way from supervisors here. Supervisor to middle management and top management. When managers throughout the organization work collaboratively to prepare budget, they often strive to establish challenging budget. They are highly achievable. So this is more like bottom-up approach style. Advantage of self-imposing budget is shows respect in terms of their opinions. Estimate and prepare from the managers are often more accurate and provide motivations to the individual that participate and empower them and to take ownership. So you have a bottom-up approach. That's the advantages. And self-imposed budget management review is that self budget should be reviewed by higher level management to prevent budgetary slacking. Most companies issue broad line in terms of raw profit and sales. Lower level managers are directed to prepare budget to meet those targets. In terms of budgeting, over part one, sales budget here, all the way to production budget. There's an ending inventory budget here. In terms of production budget, you have the direct materials budget, direct labor budget, overhead budget. There's three-part component and production budget there. Okay. For sales budget, you also have selling and risk budget here. And it ties directly to the cash budget. This is the diagram here. Sales budget all the way to budgeted income statement, as well as go to budgeted balance sheet. Cash budget also impacted budget income statement and expected budget balance sheet. So the key part here is sales budget has an impact In terms of get budget, this has an impact. In terms of income statement, it also has income, selling and budget. In production budget, you have the three components here: three direct materials, direct labor, and matching overhead. Okay. Let's look at the big picture here to help you understand that 10 schedules in the master budget are designed to answer the 10 questions shown on the next screen. What are the 10 questions? From revenues, cash, collections, raw materials, manufacturing costs, how much cash in terms of you need to supply to pay your suppliers, how much total cost that can transfer from finished good, how much you're selling and which expense, how much money you need to borrow and repay loan, how much printing that will be earned, and what is the balance sheet look like at the end of the budgeting period. There are the 10 questions there. And then in terms of master budget, it is based on various estimates and assumptions. For example, the sales budget requires three estimated assumptions as follows, such as budgeted unit sales, budgeted selling price per unit, and percentage of consumable will be collected at the current subsequent period as well. Okay, you can use Microsoft Excel as standard to create master plan for this type of assumption. Thereby enabling Excel budget to answer what if questions. So usually the standard is using Microsoft Excel. If you do not have an Excel, you can use an OpenText document here that is available worldwide. Okay, you can also download that one. Okay, the standard either Microsoft Excel or Google Sheet, or we call it, or OpenText, a spreadsheet. Learning objective number 2. We must prepare sales budget, including schedule of expected cash collection. What are the budget example here? For example, here, printing budget for quarter ending June 30th, from April to August, from 20,000 unit all the way 20 to 15,000. The selling price is $10 per unit. So when you have a budgeting example like this, you're gonna have a sales budget in the terms of individual from April to June, April, May, June, quarter. So you're gonna hit, this is per quarter: April 20,000, May 50,000, June 30,000. All the way you're gonna have selling price per unit. So total is 1 million in terms of dollar, because it's quarterly is 100,000. Okay. Also are based on account. Royal collection pattern is 70% collected in the month of sales. This is based on pattern. 30% collected in the month of the following sales. For the March 31st, the account balance of 30% will be collected in full by April to April. Okay. In terms of April, here you got account receivable 30,000. A quarter is 30,000. 70% is in terms of expected collection. Here is example. The first April sales are 70% April. Second one is 30%. This is the typical expected cash collection budget. Okay. For the mail sales, the same thing. You're gonna do the same thing. So you're gonna do it step by step. Okay. All right. That's based on the sort of logic. Now look at this. Refer to the misinformed price slide. What will be the total cash collection for the quarter? It is A, B, or C, or D. Let's take a look. Take a pause for a couple of seconds. So the answer for this will be C. How do you get the C? This is the calculations. Okay, 940,000. So you're gonna go back here, look at the calculations. It's 190,000. That's how you get the calculation there. Okay. All right. Because the previous one you got the 700,000 there. Okay. Sales budget in May. Okay. All right. All right. Let's look at the logic here. Look at the logic. This is given to you here. Okay. And then look at the next logic, which is the objective number 3. Prepare a production budget. You get a sales budget as well as expected budget. We'll go to production budget. The production budget must be adequate and meet budgeted sales and provide desired ending inventory. All right. In terms of production budget, Royal Company wants ending inventory equal to 20% of the following month budgeted sales. In March 31st, you got 4,000 units were on hand. Prepare production budget. If the Rochelle was machinery, it would prepare machinery budget. So how are you gonna do that? Is remember, 20% is the key. Okay, this is the given to you, and then you got a logic here given to you. You want a 20% ending desired inventory. Okay, so that is budgeted sales. You got to add desired ending 20 inventory, which is 50 times 20, which is 10,000. Okay, design inventory, you got the total needs 30,000, less beginning inventory 4,000, required production 26,000. Remember, this is based on the desired ending inventory. So the next logic will be given to you. This is a question. Refer to what information slide. What is the required production of May? The question will be B. Okay, so how are you going to get that logic coming from? Is from here. Okay, this is where you got that logic there. Okay, 46,000. This is the 1st April. Remember, the 1st April we got that calculations. The second one May, because it's ending inventory, it's going to go to the here as the beginning for May. Okay, and then on July and June and July, we're going to get the 20%. So the target is 20%. Remember, the target is 20%. So July sales, let's say July sales is 25,000 unit, which is 5,000 here. When you get a 5,000, the quarter will be 5,000. Design inventory, you got 4,000 beginning inventory quarterly here. Okay, so that's where the logic coming from. All right, let's look at objective number 4. Prepare the material budget, including schedule, expected cash disbursement of purchase materials. When you have like this objective, example of recognized budget, 5 pounds of material are required per unit for products. Management wants material on hand equal to 10% of the following production. So on March 31st, you got 13,000. Material cost is 40 cents. Let's prepare the direct budget. Once you prepare, you're gonna get this logic. This is your first direct material budget. Okay, 26, 46, 29. You got 101,000. Again, you got materials per unit per pounds. Then you got productions need here. Multiply all of them. Then you go to the next level. You got 13,000 here. Okay, this is 10% of the following month's needs. Where do you get the following month's needs? This is the one. 30% here. Okay, and then you got totaling up 143, 130 plus 33. You got 143. Where you got the 33 from the following productions. You got the March 31st inventory beginning here. So you got materials to be purchased 140,000. For the next question, the concept check. How much the material should be purchased in May? In May, okay, the answer will be for this question is A. Okay, how do you get the A? This is where you get this A, 22,000. Okay. Okay, go back again to the questions. 221,000. This is the one. Okay, 221,000. That's how you get that calculations. This logic here given to you. Okay, from here and this ending become beginning here in May. Okay, then look at the next slide. This is going to be the same thing, 14,000, but this is ending 24 quarter here. Beginning inventory will be 13,000 here. Okay, all right, let's look on the next line. Royal pays 40 cents per pound for its material. One half of the amount purchased is paid for the in-month purchase. The other half paid for the fund for the following month. March 31st account payable is 12,000. Let's calculate the expected disbursement. The expected disbursement will be, let's start here. Account payable is 12,000 there. Okay, then you got per purchase 50,000. 50% each, 28,000. April, 50, May, 28,000. Where do you get that number from? 143,000.40 cents. You get this 46,000. Okay. So when you calculate the logic here, this is the accumulated cash disbursement for the materials of the quarter. So refer to what the prior slide. What are the totals for the quarter? Either A, B, C, or D. Let's go back again to the logic. A, B, or C. Remember this logic given to you. Okay. These are the first 3 slide chapters you can understand. So this is the questions. Okay. A, B, or C, or D. The total disbursement. The answer will be A. See, how do you get that number? This is the calculations. Okay. All the way April, May, June, every quarter you add it up. Here you got all of them up, 50-50 here. This is for April, this is for May, this is for June. Look at this, you got 185,000. So you're gonna, it's a tedious work, okay? It's not an easy, because in any job costing and management accounting, all is quite tedious. You have to do it step by step. You got the 1st April here, 50%, you got that 1st April, right? And then the May purchase, you got this first March up to June, and then your June purchase, you add all of them for quarter, you got 185,000. So that's where the answer is for that particular questions A. Okay, then look at the next one. Account payable will be 56,800 times 50%, which is 28,400. Okay. All right, let's look at the objective number 5, which is prepare direct labor budget. In direct labor budget, we have a royal unit 0.05 hours for 3 minutes of direct labor. The labor will be unskilled because the production process is less simple and formal. Training is not required. Royal pays an average rate of $10 per hour. So prepare direct labor budget. So you're going to start direct labor budget. You're going to start here April, May, June, the same time. But this time is labor. Remember, this is labor. So labor, you're going to have the second logic here, labor per unit, 0.05 each. So your labor hour required is 1,300 for April, May is 2,300, June is for 1,450. Then you're going to have to pay, remember, hourly rate is $10. So you got this calculation, 13,000, 22,000, 14,500. Quarterly, you add it up, 50,500. Remember, guys, you have this is direct labor per unit for each production unit. You're gonna labor hour required about 1,300 labor hours, but you pay $10. Okay, so you're gonna go do it step by step from month to month, April, May, and June. From then, refer to what information price chart. What would the direct labor cost of the quarter will be if one half, 15 hours, or 10.15 for all the hours work for employee in excess of 2,000 per month, either A, B, C, or D. So the answer will be for this question is, take your best guess, okay? Will be B, okay? How are you going to get about the B? This is how you're going to calculate, okay? 1.5, remember it's 1.5, 1,300 here. For regular hour is 4,750. The overtime is 300. Remember, it is 1.5. Every time you do work overtime, usually the company will pay you 1.5 times over. So you got here 4,700. Where you get the 4,750 coming from? You add all of them up here. Okay. So 4,750, you got 300 here. Okay. I guess the regular time is here, 4,750. And then the excess one is here, May, 300, overtime at 315, 4,500, so you got 40, 50, 2,000. So you're going to do step by step here. Labor hours required for April, May, and June. This is the part, the first row. Second row is regular hours. This is what you pay for 7,500, but you get excess overtime is 300. So this is the excess overtime. You need to call it by $15 because it's 1.5 times. Okay, you got the 52,000. That's for concept check number 5. And then prepare for managing overhead. It's the same story. We're gonna start again. Royal managing overhead with variable managing overhead rate is $20 per direct labor. Fixed managing overhead is 50,000, which include 20,000 in non-cash costs. Let's prepare the manufacturing overhead. So we're gonna prepare here. We're gonna use the same kind of logic numbers. You got the direct labor 1,300, 2,300, 1,450 for June. So you're gonna get overhead $20 each. So you're gonna get 100 direct labor. Okay. So when you're gonna do direct labor cost, you're gonna calculate the fixed manufacturing overhead. 50,000 here, 50,000 here, 50,000. You got 150,000. The total is 76. You got the total per quarter is 251,000, and then you're gonna divide by how much? 5050. Where you get coming from? 5050. The quarter here. Okay. You're gonna add all of them up. You're gonna get quarter here. This is from 250 how much over total. Where you get this number from? Here, 101,000 plus 150,000. You got 251,000. You got 150, 50. You got 49.70 per hour. It is rounded there. Okay. So in terms of the non-cash depreciation is a non-cash charge. So there's a non-cash charge here as well. For less non-cash cost, 20,000. So you get the 56,000 here for April, 76,000 for May. June is 59,000. Quarterly will be 191,000 because it's a non-cash charge. When you do have a non-cash charge, and then in terms of adding inventory here, deck materials you got $5 per pound for 40 cents. You got $2 in terms of informations, and then you get the direct labor. 0.05 times 10, you got 0.5 here. And then for the monitoring overhead, you got 4970. Where you got this coming from? 251 divided by 50/50. You get 4970 there. When you add all of them up here, you got 499. Okay. And then ending inventory is 5,000 per unit times 4.99. The ending inventory will be, we just multiply them. Okay. All right, let's look at the next one. Objective number 7, prepare selling and administration budget. Is the same kind of logic given to you. So you're going to look at the variable unit is 50 cents per unit, fixed selling price. Expense is 70,000 for fixed costs. So selling expense include 10,000 in costs and primary and depreciation costs that are not all cash outflow for the current month. So I'm going to look at the budget here given to you for administration expense for April. 20,000 times 50 variable, you got 10,000, you got multiply here, you got a fixed expense here 70,000, you got 80,000, non-cash is depreciation, total 70,000. This is calculate selling and expense per quarter. Okay, so how you gonna calculate for the check? Based on the cash distribution calling quarter for this quarter, either A, B, C, or D. Okay, take out 2 seconds. The answer will be B. Where do you get this number from? Okay, look at, we're gonna go to the next slide to give you where the logic coming from. This is how you get that logic, 230,000. Okay, you're gonna analyze this slowly, piece by piece. Okay. All right, now number 8, prepare for the cash budget. When you do a cash budget, there is divided into 4 sections: cash receipt, cash disbursement, cash in excess or deficiency, or financing selection. So these are the 4 cash budget in terms of sections. So what do you need to do? We assume for the Royal, maintain a 16% open line of credit for 75,000, maintain the cash balance 30,000, borrow first month on repay loan and last day of the month, pay cash dividend 49,000, purchase 100 free equipment in May, and 448,000 in June, has an April 1 cash balance 40,000. Okay, this is your assumption. This is your assumption given to you in this particular slide. Okay, so 40,000 as collection, schedule expected 170, you got 210. Go to the next level, schedule cash disbursement 40,000, 30,000. You're gonna plug in all those overhead. You get the selling expense as well. Here 70,000. So you got the disbursement 228. Okay. Once you got the disbursement, so you got this cash available 210, disbursement 228. You got the shortage, deficient 18,000, but you need a borrowing 48,000. So ending cash balance 30,000. Okay. This is given to you in the first previous logic questions. So you got this efficiency of 18,000. So you need to borrow 48,000. The remaining ending cash balance is 30 grand. So you're gonna continue 30,000 here. You're gonna continue here. You're gonna plug in all the numbers again, and then 40,000. You got it for May. Okay, so you got the April numbers. You got the May numbers. Refer to the previous slide. So how are you gonna access deficiency for this month for June? A, B, or C, or D? So the answer will be for this one will be, take your best guess, at least D. Okay, so how you get this D? 130,000. This is you get that number. Okay, you're gonna give this number, you plug in that number. Slowly, piece by piece, you get the interest payment. Remember here, where you get this number? 48,000 times 16% times 312 is 1920. Repayment borrowing. Okay, you got plug in the numbers there. Okay, you got 130,000. All right, let's look at this cash budgeted completed. Then you're going to go budget income statement with interest rate from cash buyer, or I can prepare budget income statement. You're going to prepare a budget income statement. When you do so, objective number 9, and then you're going to plug in the numbers, sales budget, in the inventory, selling and administrative expense. So you're going to get here, sales $1 million, CGS is $499, which is based on ending inventory. You got the gross margin for 501,000. You got sales and expense 260,000, operating income 241,000, and then you got the intersection 1920. Remember where you got the 1920? From here. From the previous one, there you go. Okay, this is the one. All right, that's where you get that number from here. This is the calculations. Okay, let's look at this example again. Move forward to the next one. Okay, there you go. All right, and then prepare objective number 10, prepare a budgeted balance sheet. You're going to put the balance sheet here. And this is the assumptions given to you. Land 50 grand, common stock 150,000, returning 248,000, 650, 248, 650, sorry, April 1, and then equipment 175,000. So you're going to plug in that number, cash, sales account receivable is 30th of June based on 300,000. Raw materials 151,040 cents at 40 cents. Finished good 5,004.98. So you all these numbers coming from the previous slide. Remember from 1 to 8, we go over that. And then 50,000 from the purchase 56,000. Okay. And then once you do that, you're going to find a retaining 438,730 where you get coming from. You got the beginning balance, you get the net income minus dividend, that's for the 138,000 ending balance. So that's how you get into that budgeted. So that's basically cover the summary in a quick way. But basically what you need to do in this particular chapter, you really have to get your hands dirty and practice it on hand. Because if you do, accounting is like playing soccer, playing basketball. You need to practice it because this number is not that easy to do. You have to know how to calculate properly. Okay, so we're gonna go into dive into that chapter, into that book, and hopefully you can use it. So basically, this conclude this chapter. Hopefully you enjoy. And I'm gonna try to put it in the. I'm gonna post it as well on the YouTube as well as in puzzles, so you can practice your exercise as well for this lecture for this chapter. Thank you. Bye bye.